Robo-advisors are changing how we invest, folks. They're like the automated version of your financial advisor, using fancy algorithms to manage your money. But instead of stuffy offices, you get everything online. That means lower fees and easier access for everyday investors. Whether you're just starting out or you're a seasoned pro, robo-advisors are worth a look. They could be the future of investing. So how do these robo-advisors actually work? Let's dive into the fascinating world of algorithms and see how they manage your investments. It's all about algorithms, folks. These powerful tools are the backbone of robo-advisors. These are basically sets of rules that the robo-advisor uses to make investment decisions on your behalf, ensuring your money is managed efficiently. They take into account things like your age, risk tolerance, and financial goals, tailoring the investment strategy to suit your unique needs. Let's say you're a young investor with a long time horizon. The algorithm will consider this and make strategic choices. The robo-advisor might put more of your money into stocks, which have higher potential for growth, maximizing your returns over time. But if you're closer to retirement, it might suggest a more conservative approach with more bonds to protect your savings. The algorithm does the heavy lifting, constantly adjusting your portfolio to stay on track, ensuring your investments align with your goals. One of the biggest advantages of robo-advisors is cost. Traditional financial advisors often charge hefty fees, which can eat into your returns. Robo-advisors, on the other hand, typically charge much lower fees. That means more of your money stays in your pocket. Another big plus is convenience. With robo-advisors, you can manage your investments from anywhere with an internet connection. No need to schedule appointments or meet with someone in person. It's investing made easy and accessible for everyone. Section 4. The downsides, what to consider before you dive in. Of course, robo-advisors aren't perfect. They come with their own set of challenges and limitations. One potential downside is the lack of human interaction. This can be a significant drawback for many investors. Some people prefer to talk to a real person about their finances. They value the personal touch and tailored advice. If you're someone who likes to bounce ideas off an advisor or get personalized advice, a robo-advisor might not be the best fit. You might miss the nuanced insights that a human advisor can provide. Another thing to consider is that robo-advisors are still a relatively new phenomenon. They are evolving, but they haven't been around as long as traditional advisors. While they've been gaining popularity in recent years, they don't have the same track record as traditional financial advisors. This can be a concern for those who prefer a proven history. It's important to do your research and choose a reputable company. Look into their credentials, user reviews, and performance history to make an informed decision. Section 5. Robo-advisors versus humans, a look at the differences. So how do robo-advisors stack up against traditional human advisors? Let's dive deeper into this comparison. Well, it really depends on your individual needs and preferences. Each option has its own set of advantages and disadvantages. If you're looking for low-cost automated investing, a robo-advisor could be a great option. They offer convenience and efficiency. But if you value personalized advice and human interaction, a traditional advisor might be a better fit. They can provide tailored advice and build a relationship with you. Ultimately, the best choice for you depends on your specific circumstances. Consider your financial goals, risk tolerance, and the level of support you need. The important thing is to weigh the pros and cons of each option and make an informed decision. Take your time to research and understand what each advisor offers. Whether you go with a robo-advisor or a human advisor, the key is to start investing early and stay invested for the long haul. Consistency and patience are crucial for financial success.